This podcast is solely for the attention of institutional, professional, qualified, or sophisticated investors and distributors.
Hi everyone, today we're going to talk about the March 16 Fed's Monetary Policy Committee. This FOMC had a particular flavor because it was generally expected that the Fed would raise its key rates for the first time since December 2018, and especially for the first time since the COVID-19 epidemic. Indeed, it had become more and more obvious to observers that the Fed was late in its monetary policy normalization cycle, with inflation at 7.9% in February, almost 4 times the 2% target, and with the unemployment rate at 3.8%, one of the lowest unemployment rates since World War II. There is obviously a lot to say about this FOMC, and we can perhaps start with the decision on key rates. The rate hike at this committee was only 25 basis points. Only St. Louis Fed President James Bullard voted for a 50 basis point hike, showing that while the press is fond of him for his hot takes, his statements should be taken with a pinch of salt since he seems to be quite isolated. Even board member Christopher Waller, to whom he is very close, voted for a 25 basis point hike. Then, the dots, that is to say the Fed funds projections of FOMC members, have been very significantly revised upwards. The median indicates 7 rate hikes in 2022, compared to 3 previously, and 3 in 2023. And the tightening cycle would be already over. This would put the Fed funds target range at 2.5–2.75% at the end of 2023, very slightly above what FOMC members consider to be the long-term rates, around 2.5%. During the press conference, there was a question on the pace of rate hikes in 2022. Powell did not want to answer precisely, but he betrayed himself a bit by talking about 7 rate hikes. So we can conclude that the base case scenario is 7 rate hikes of 25 basis points this year. And we can definitely link this implicitly announced regularity to the wish recalled by Powell not to add volatility to volatility. It's a form of compromise, yes to tightening, but trying not to harm the financial markets too much. The underlying fear is of breaking the credit markets. Among the other clarifications that we had at this committee, Powell reconfirmed that the reduction of the Fed's balance sheet will most likely be announced at the May FOMC, even if there would be already some details in the March FOMC minutes. Powell said that it would be similar to the 2017, 2018, 2018 episode, but at a faster pace. So we can imagine a balance sheet reduction pace of around $100 billion per month. There are also several interesting elements in the economic forecast of FOMC members. That's a bit paradoxical, but the cut in the 2022 growth forecast is much sharper than for the ECB, as it drops from 4% to 2.8%. And on the justification of the cut, Powell indicated that it was largely due to the consequences of the war in Ukraine, a little from the Fed's tightening, but he did not give much more explanation. We can imagine that the fall in equity markets has led FOMC members to be a little more pessimistic. That said, Powell repeatedly said in its press conference that economic growth would be very strong this year. Inflation forecasts have been revised sharply upwards, 4.3% in 2022 and 2.7% in 2023. Here we can think that the strength in the 2023 inflation forecast is linked to the very rapid rise in rents. Powell also said that the price increases are becoming more broad-based and that the supply chain relief one might have expected will not happen because of the war in Ukraine. But one of the most striking points of the press conference was Powell's admission of failure. His new language is that the Fed must now restore price stability, a phrase used 10 times during the press conference and which implies that price stability has therefore been lost. He even mentioned a fundamental obligation to restore price stability. The Fed therefore acknowledged for the first time that it is behind the curve. To sum up, the Fed has started its normalization cycle, and it seems that FOMC members would like it to be as much as possible on automatic pilot for the rest of the year, which means regular 25 basis points rate hikes in order not to harm the financial markets too much. But the big question now is going to be whether the Fed is able to stick to the script. For example, if inflation is at 7 or 8% this summer, FOMC members might be tempted to go faster. Thank you for listening and talk to you soon.
All comments and analysis reflect CPR AM views on market conditions and its evolution, according to information known at the time. As a result of the simplified nature of the information contained in this document, that information is necessarily partial and incomplete.